The following content is meant purely for educational and informational purposes and should not be relied upon as financial, investment, legal, tax, or any other professional advice. This is the Fundamentals podcast, where we demystify crypto and help you navigate this ever-evolving internet-native economy. In this episode, we're joined by Matthew Sigel, Head of Digital Assets Research at VanEck. VanEck is a global investment management firm with over $100 billion in assets under management as of March this year. VanEck offers a range of vehicles including ETFs, mutual funds, institutional funds, separately managed accounts, model delivery portfolios, and more. They were one of the first U.S. asset managers to offer investors access to international markets and early recognized the transformative potential of gold investing, emerging markets, ETFs, and now digital assets. Matthew and members of VanEck's investment team frequently share their latest market observations and analysis on crypto and broader digital asset technologies on their blog. They do a great job at combining traditional asset valuation models with the unique characteristics that digital assets and on-chain data bring to the table to share high-signal information with investors. In this episode with Matthew, we discuss the state of VanEck's Bitcoin ETF, the growth of the broader Bitcoin ecosystem, understanding value accrual, the differences in VanEck's valuation models for Ethereum and Solana, the pros and cons of on-chain data, what are the line items that Matthew looks at on blockchain's P&Ls, how he defines economic sustainability, and more. Tune in for a great episode about the fundamentals of crypto. But hey, there's one thing that I wanted to ask you right before we actually dive into the core of this session is that Market Vector recently launched a meme coin index. And looking at kind of the social response based on what you've been tweeting around it, I had to ask that, did that piss a lot of people off? Or what was kind of the reaction that you got?
I think the reaction to our meme coin index has been quite positive, aside from individual communities, lobbying for their coin to be either in it or out of it. It was funny to see the Dogecoin community be like, hey, we're not a meme coin. We have real utility. We shouldn't even be in this index. That was humorous. Our indexing subsidiary sometimes puts out indices for intellectual purposes, just to give stakeholders a better window into the performance in the space and what's working and what's not. And sometimes when they launch an index, there's a customer behind it who has agreed to license the index and maybe has provided some bespoke input into the coin coverage or certain classification. So I think you'll be seeing an announcement from them in the not too distant future about the customer who licensed that index. Not to say there'll be an ETF. There can't be an ETF on these coins yet because there's no regulated futures market on the CME, but exchanges and other asset managers can still do creative things privately or on chain using these indices. And interestingly, the meme coin index is the best performing index of the month, at least according to the dozen or so that I track on my screen.
Yeah, that is quite wild. And actually a fascinating data point that it's actually a meme coin community themselves that kind of got upset about it, because you would have imagined that it could trigger maybe a more traditional or institutional side of audience to bring a meme coin index, but it's actually the communities themselves. Quite interesting. One thing that I've been thinking about quite a lot that I wanted to ask you about is that we actually at Token Terminal as well have an index suite with Market Vector, the Token Terminal Fundamentals Index Suite, which is the first of its kind to kind of track these network effects, core adoption, like fundamentals-based active user fee metrics as well, and build a basket based on that. In terms of meme coins, I believe like the first one, it's a market cap weighted index. But going forward, as these are social communities that have like social sentiment based, you could argue that they have somewhat fundamentals in this internet native economy. Do you think we'll ever get to a stage where, in addition to market cap, we could be assessing memes based on some sort of fundamental user adoption or network effect type metrics?
I think it's possible. I can imagine maybe something with analyzing social media for how prevalent the meme is. But when you make an index like this, you have to have third-party data that validates those fundamental criteria. And I think one thing we've observed from working with Token Terminal and the fundamental indices, which I track quite carefully, is that a lot of times there's no standardization around what is the single metric that should be watched. And then even if people agree on that, it's hard to find a neutral data provider who brings the reliability that a TradFi index provider would would want. So there's still some hurdles. They're not insurmountable, though.
Yeah, well, 100% agree with you. That's something I've been thinking about a lot is how do you really seamlessly combine on-chain and off-chain data points in a way that they are as trustworthy that you can actually make decisions based on them. But, we'll see how things develop going forward. But let's get to these, maybe in one way to put it, more legitimate digital assets at this stage. And I see you're wearing the HODL cap, which is great to see. I wanted to start from there and speak a little bit about the Bitcoin ETF, especially yours. How has that developed relative to your initial expectations since it's launched?
We've been quite pleased with the collective performance of the 10 new spot Bitcoin ETFs. Collectively about $13 billion in inflows, the best ETF launch in history, if you add them all together. And now that we've had them operating for a couple months, the SEC filings are starting to trickle out that show who actually bought these products. And I think some of the takeaways from that data is that most of the buyers of decent size have been more the independent investment advisors. Collectively, those independent advisors have about $8 trillion in assets under management or assets under advisement. Roughly 25% of the assets under management by institutional investors in the US. So there's still 75% to go. The bank-owned wealth managers, the broker-owned wealth managers, so-called wirehouses, those are the entities where VanEck's traditional relationships lie, who've been buying our ETFs for decades. And that's tens of trillions more of assets under management. So if you assume that Bitcoin can reach, say, a 1% penetration rate of that institutional landscape, which I think is many, many years down in the future, but you're still talking about tens of billions, if not hundreds of billions of inflows. And for those to materialize, it's going to require asset allocation models that incorporate Bitcoin. So instead of 60-40, 60-39-1 or whatever the model is. And generally the chief investment officer of one of these wirehouses sets that broad asset allocation strategy, and then it slowly trickles down to the advisors who get on the phone and kind of pump that to their clients. And that has hardly materialized. So I think that's going to be second half of the year, 2025 to 2026, multi-year story.
Got it. So there's a lot of untapped potential there still. And would you say that at the moment it's mainly due to the lack of these asset allocation models that include Bitcoin or any digital asset allocation? Or is it also a function of a lack of interest on the institutional side to create these models?
I think the two are very linked. So, banks still control such a large part of the wealth management business in many countries. It's lower in the US than it is in some other nations, but there is a political dynamic there where bank CEOs are being told explicitly by their regulators that this is a risky area with no intrinsic value, and they should be tread very carefully, first and foremost in custodying the assets where there are some very onerous capital requirement and other logistical hurdles for banks, but then even just in advising clients. The top management has a lot of innovators' dilemma, I would say, in fully embracing this asset class.
Got it. That makes a lot of sense. And as you said, it'll probably take several years to get to unlock that and open the floodgates. So is it fair to say that if we think of short to midterm over 6 to 12 months and thinking about Bitcoin ETF flows, you see that staying somewhat stable?
Yeah, I mean, I think that the summer is generally a quiet time. And when you look at Bitcoin seasonality, the best 2 months of the year are October and November. And that lines up with the election cycle, where generally the market it kind of has a sigh of relief once we know who the victor is, and that kind of bakes in the cake another 4 years of unfunded deficits and money printing. And there'll probably be some kind of short-term macro traders who maybe try to get ahead of that seasonality and that election certainty. And then meanwhile, we have this trickle of what we hope are asset allocations by larger wealth managers that include Bitcoin, and that will attract the stickier flows. So I still have some quite high confidence that, by the end of the year, we are sitting, quite a bit higher for BTC. And some of that will be driven by, new institutions that are taking a strategic allocation, and some by shorter term macro traders.
That's great to hear. Now, I want to move on to speak about Bitcoin, the asset, and the broader ecosystem in a bit more detail, because I know you are quite bullish on both the asset and the ecosystem. I've spoken at length about the fact that Bitcoin as legal tender will 10x, DeFi, NFTs, and yield will gain traction on Bitcoin over the next year. I was wondering if you could elaborate a little bit about what kind of activity you believe we'll be seeing on Bitcoin going forward.
Generally, we see Bitcoin as the tail that wags the whole digital asset dog. It is the purest anti-US dollar bet that an investor can make, and they're generally motivated by trying to preserve purchasing power and store wealth in a monetary system that is transparent and immune to overprinting. And inevitably, once the realized profits within the Bitcoin system reach a certain level, stakeholders inevitably look to either sell their BTC and speculate on something riskier and newer, or sell calls and try to lock in some of the BTC gains that they've had without actually exiting the asset, paying taxes, or lock in some type of yield, basically, in return for a capped upside. So folks no longer see a 10x in the near term, so they will lock in a 10% APY and limit their upside. And that's a kind of, I think, a fundamental human desire, which occurs in lots of different assets, and typically gets very heated at the top of the Bitcoin cycle. Last cycle, that demand for yield was satisfied by centralized blenders like Genesis, 3 Arrows Capital, Voyager, BlockFi, the list goes on. Essentially, all of them went bankrupt. So when you look at who's going to supply the credit in this next cycle, we've noticed, some institutions are kind of picking up that slack, even Coinbase doing a bit more lending, but it hasn't yet made up for what was lost through all of the bankruptcies. So when you think about who's going to provide that credit, we think it's going to come on the margin more from retail and more on chain. And when ordinals and BRC20s first came out now a year ago, those were new innovations on the Bitcoin blockchain that had the potential to drive a meaningful amount of fees. And so I think they ignited some optimism that maybe those fees can be spread around in a way that incentivizes folks to lock up their Bitcoin self-custodially. Meanwhile, you've got a lot of whales, Bitcoin whales in Asia, here too, but in Asia, including many miners who are really interested in building ways to gain yield on Bitcoin that don't involve letting others custody their assets. You have a problem of user interface, which is that many users of the current Bitcoin stack, those assets generally don't have good UI. You're not able to earn more yield on them. And so what we've had through this union of the supply, the Bitcoin whales, and the demand, the desire to earn yield, is the birth of these so-called Bitcoin L2s. And they really vary so widely in how they operate. We're basically breaking them down into into three different models, and we can get into what they are. But that's kind of how we see it developing is so much demand to earn yield and no centralized balance sheets that have really stepped into the space. So instead, a long tail of protocols that are looking to intermediate that credit creation.
Yeah, that is really interesting, and I think much more healthy development from where we saw the yield come from in the previous cycle. So that is always great. But on the Bitcoin ecosystem, that you alluded to the fact that we're seeing things emerge on the Bitcoin layer 2 section. There's three different models there. I'd love to dive into that. So could you maybe speak a bit about how you see the evolution of these rollups and sidechains on Bitcoin developing, and are there any specific projects that you are currently focusing on?
Yeah, I think I'd separate them into three main models. One is like these merged mining models where a miner is essentially mining another chain's proof of work system alongside Bitcoin. The second is Bitcoin as a data availability layer, where the L2 is essentially just posting periodic proofs of activity onto the main chain. That's the one where we think there's probably some differentiation and maybe more hope. And then you've got the third, which is kind of just general side chains with a bridge. That's often multi-sig. And that number third seems kind of most similar to some of the existing EVM compatible Bitcoin L2s, I'd say, like, Avalanche trying to bring Bitcoin on chain, Stacks trying to bring Bitcoin on chain. So I guess our conclusion is that the differentiation is so far it's challenging in this space for these projects to differentiate. They rely mostly on like the ecosystem, how many apps they can onboard and how much kind of social activity they can generate. The whale and miner TVL, just how much Bitcoin they have committed to their chain, what type of virtual machine they use, and then the team behind it. So we count dozens of these in the strategy that I'm running, more focused on large cap liquid tokens. There are very few that I think are investable at this moment. My general sense when I manage a portfolio of these assets is that in order to get conviction to buy one, I need to get comfortable that the asset in question can be a category killer and take all the economics in the space, or at least 70 to 80% of the economics in the space. I can't say I have conviction on that among any of these Bitcoin L2s just yet.
Okay. Yeah, that makes a lot of sense. Now, as the Bitcoin ecosystem develops, it brings forth some like interesting considerations in my mind from an investor's perspective, because it's pitched as an inflation hedge. It is just purely a fixed supply asset. And now that you have DeFi being built on top and broader activity that's generating fees as well, I'd be interested in hearing your thoughts on how these developments change the economics of the Bitcoin blockchain, and especially from the perspective of how investors should be looking at it from a portfolio construction point of view.
Yeah, the key differentiation of Bitcoin versus the thousands of proof of stake coins is that additional activity on the Bitcoin blockchain doesn't accrue to token holders, but rather to miners. That's not to say that the higher transaction fees aren't positive for the ecosystem. I think, within a happy medium, they are, because that gives the miners some economic profits and allows them to continue to be motivated to provide security to the chain. And when we look at the impact of ordinals and BRC20s and inscriptions in April of this year, so the month ending 2 weeks ago, transaction fees were almost 15% of Bitcoin miner revenues. A year ago, it was 4%. So it's really been a sea change in terms of the leverage that miners have to these transaction fees. And I think you asked from a portfolio construction point of view, all things equal, I think it makes the miners more attractive, the equities of the publicly traded miners. And we could spend a whole hour on these stocks. There are so many more of them this cycle that are investable. The publicly traded Bitcoin miners now control a record percentage of the global hash rate. It's now over 30%. The largest Bitcoin miner in the world went public this year in Abu Dhabi. So one way to answer your question is that, and they've all deleveraged, right? Partially because many went bankrupt and had, major debt restructurings in 2022 and early 2023. But that sector, I think, is much more investable. The second way that it's changed portfolio construction, at least for me personally, the strategy that I'm managing is a long only buy, stake, and risk manage the largest and most liquid L1s and L2s. And our benchmark, it doesn't include Bitcoin actually, because we tell clients that Bitcoin is a separate allocation. It's distinct. It's not Turing complete. There's unlikely to be the same amount of smart contract and automation that goes on with the Bitcoin blockchain. But when ordinals came out a year ago and fees really exploded, and you mentioned the market vector token terminal fundamental blockchain index that weights constituents on fees and addresses, and you started to see Bitcoin become a major constituent in that fundamental index coming from essentially zero. So I had a choice to make in my strategy is like, do I acknowledge that maybe the lines between BTC and ETH have become a bit more blurry now? And that some of this smart contract functionality will migrate to Bitcoin L2s, and the winners from that may be miners, but also it'll just be BTC the asset. I said yes, I need to acknowledge this, and made a call at the portfolio level to add Bitcoin, and it's become a material part of my strategy, even though technically it's not in the index that I'm managing against.
That is very interesting, and thank you for breaking that down. And this is maybe overly simplifying it, but when we think of something like the fat protocol thesis in Ethereum's case, where everything built on top, the value drips down to Ethereum and thus then through the burn to the ETH token holders, is it fair to say that one big difference there to like Bitcoin's case is that for Bitcoin, it'll be more of like the fat miner thesis? As fees start going up, the value drips down and the miners are able to capture the majority of the value of all activity that's happening in the Bitcoin ecosystem?
I think that's fair. I think that's fair. And
Okay.
because of the fixed supply, I think the value accrues to the price of the token in a way which could be more dramatic than in other tokens, right? Because you just look at just using Ethereum L2s as a base and how much more tokens there are yet to be minted for many of those chains, still 80% of the supply left to go. And what that means is that in down markets, the drawdowns are just so much bigger. And we haven't seen the token generation events really for these Bitcoin L2s, but I don't know if the incentives for the issuers are any different, that we'd see a lot of things come to market with very high fully diluted valuations and then just massive token supply over the subsequent years, and Bitcoin, the main BTC asset, just becomes the thing that everyone buys when they're selling those tokens. So much lower volatility. The miners are tricky because they just keep issuing shares. Many of them, have unpredictable balance sheet strategies, and you end up getting diluted owning those as well. So when I think about fat protocol thesis, like I I understand the distinction that you're making, but BTC is also a protocol. So I think my mental model for the entire thousands of digital asset tokens is that it's going to be a very small handful that capture 99% of the value, and BTC is likely to be one of those, if not the one.
Very, very great addition. I agree with you 100%. And that's the issue when you ever try to overly simplify some concept in crypto, it never works. But yeah, that is great to hear and understand how the value accrual actually works in the Bitcoin ecosystem as well. Now, moving on to maybe Ethereum and Solana a little bit to speak about one of these proof of stake chains. VanEck has published valuation frameworks for Ethereum and also for L2s and then Solana. And what is interesting to me there is that you see around a 10x appreciation potential on both Ethereum and Solana, while Solana is currently monetizing at a much smaller rate than Ethereum. Does this mean, from your point of view, that Solana needs to become several times larger in terms of GMV or total transaction volume for the network to achieve the bull case valuation that you have set out?
The short answer to your question is yes, because of Solana's much lower transaction fees to the end user. This system requires, I think, a higher velocity of money to generate the same amount of economic value. But we think that Solana has some inherent advantages that make that scenario more likely. And one of them is that the MEV opportunity for Solana is very large and constitutes a much greater percentage of Solana value creation versus Ethereum value creation. But if I were to step back a minute and kind of give some context, I think you're referring to the report that we put out last October on Solana when the price was about $30 and we had a base case of $300. And if I take a step back and kind of explain how we do our models, generally we want to own projects with great doxed teams who are building products that are better than their TradFi analogs. And in an ideal situation, the project can be a category killer in its sector, potentially take all the economic value in a given end market, which is common for digital platforms. And then we model the end markets and we assume some level of open source penetration. Say, 5% if we're talking about core banking, maybe as high as 15% if we're talking about video games. And then we assume that whatever project we're analyzing can take 70 to 80% of that market. And that's a typical base case. So in a portfolio, you end up basically holding this collection of call options, and then you're managing the position size. And when it came to Solana, interestingly, when we did that initial model, instead of using 70% for our base case, we only used 30% because we figured that there's no way that Ethereum and the EVM chains are going away. And so even if Solana can achieve escape velocity with some of these killer apps and show meaningful MEV and fee generation, there's still a decent probability that it would top out at that 30% market share because Ethereum is still quite strong, and that would be maybe a more multi-chain world than we were initially thinking. Now, 6 months later, I think we have to acknowledge that Solana's product market fit is much better than it was 6 months ago, whether we're talking about the phone or some of these DePIN applications, meme coins. And so now if we normalize our Ethereum and Solana models to assume that same 70% market share, our upside cases actually become quite similar, a bit more upside for Sol still, but a lot less than 6 months ago when we first put out that report. So, we can see that Solana's daily revenues are still maybe 10% of what ETH is printing. But when you just isolate the MEV, especially that which is returned to validators and eventually to stakers, we're quite pleased and impressed with how Solana is monetizing. Still see a lot of upside there.
Got it. Yeah. Yeah, that's great to hear. Now, specifically on Solana, I wanted to hear one thing in terms of how you see them scaling in the long run. Does your thesis include thoughts on whether Solana and possibly other alternative L1s will continue scaling vertically and be able to handle all of the transactions that a crypto native economy needs? Or do you think there will be L2 ecosystems developed on top of Solana and other L1s as well?
So Solana L2s, if Solana L2s were going to be a big thing, then I think we would hear Toli talking about them more. That's my basic view, is that his stated vision for the chain is to continue the monolithic architecture and to basically try to keep up with the pace of hardware improvements and scale the chain at the base layer. And that's my bet as well, that people are going to build what they're going to build. And I just wonder what is really the incentive for an app to onboard via an L2 and end up with some of the same kind of fragmented liquidity problems that Ethereum is confronting. The stated goal of the chain is a global state machine that connects, billions of users and potentially millions of apps. And the way to do that in a differentiated fashion is to continue scaling the main chain. And that's how you can generate such a large amount of MEV as well, which is a much bigger percentage of our model for Solana than it is for Ethereum.
I think that's a great point. And actually, what you said in the beginning there is very much in line with how Anatoly answered when I asked him the same question. I think it was
Oh, really?
about 6 months ago. Yes, in terms of, and why I wanted to ask you is because, we look at things from the perspective of an investor and on on-chain data and the numbers. And right now, when you look at throughput and congestion on Solana, given the current activity where we don't have that many on-chain active addresses yet, we're still hitting some sort of capacity limits. You're seeing effects of it. So that's why I always want to hear people's thoughts on whether you believe this monolithic architecture can actually scale to support, billions of transactions, or whether every single L1 will inevitably need to scale through more fragmentation.
Yeah, I mean, I think you have to have some core convictions in this, in when you invest in technology. And for me, 15 years ago, when I was working on a equity fund and covering technology, we were, big holders of Qualcomm. This is like 2007, and Qualcomm had a mobile operating system. Qualcomm had location data. There was a chance that it could have been Qualcomm who was monetizing the world's location data and selling ads against it. It ended up being Google for a handful of reasons, but the ability to, code software at the bare metal layer is inherent in everything that kind of Qualcomm did from the beginning. And I have a great appreciation for where Toli has come from. I think it informs the vision for the chain. I think it's the right vision. What Qualcomm didn't have was a sales force to go out and onboard all the small merchants and get them integrated into Google Maps, right? That's where they ended up, was on Google Maps. I think when you look at the memes and the community of Solana, they get that the onboarding is the other side of the coin from the technology stack. And yeah, I think it's the right combination of both.
Yeah, that makes a lot of sense. Now, you mentioned layer twos on Ethereum causing fragmented liquidity. And I want to speak a little bit about that because you run a smart contract leaders fund, which much indicates somewhat of a belief in a multi chain future, maybe. How do you see the long term of the blockchain space then playing out in terms of this balance between interoperability and fragmentation? How much can we fragment it without it being too much? So basically, do you see ETH L2s being more of a few winners take all, or us having thousands of L2s?
Well, yeah, we think it's going to be a few winners take most, but it is very hard to predict, I think, how long that's going to take for that consolidation to play out. And if there's going to be, how much token price appreciation we'll actually see in the L2 sector in the aggregate, just because of all the token supply that is left to come to the market. The current roadmap of ETH by design moves a lot of its transaction throughput to these L2s. And that was done to give application developers lower costs instead of transacting on the base chain. But when we look at what's been the impact of that, we've seen reduced Ethereum revenues, at least in the short term, because of this massive decrease in the cost for users to execute transactions. We've seen user activity, which is stagnating a bit here in the kind of 400 to 500,000 users per day. And we're observing that it's basically the same users performing the same actions that they were prior to EIP 4844, but Ethereum is charging less for it. So the economic performance, the P&L, so to speak, of ETH has deteriorated quite a bit, even though the usership on the L2s is up, 50% since the fork. So we estimate that L2s in aggregate would need to increase usership by roughly another 3x. This is based on kind of an analysis of the blob usership in order to get fees back to where they had been. That doesn't mean that I'm bearish on ETH, though, because the value that's accruing to ETH compared to other parts of the tech stack, like the L2s, has not really changed all that much. Ethereum is still taking the vast majority of transaction revenues, the vast majority of MAV. It's less than Solana's taking in terms of MAV, but it's consistent with what it was taking pre-EIP 4844. So still think that value is going to accrue to the main asset if it can get more people to use L2s in the aggregate. We just need that number to go further parabolic. And in terms of like generating easy to use applications that are going mainstream, we'll see. We haven't really seen that killer app yet.
That's interesting, and I'm glad you brought that up because that is one of the main views that I've actually been staring at over the past months on Token Terminal was the trending contracts on Ethereum because for a long time it was always L2s. Top 10 most gas consuming contracts were L2s, and now if you look at it over the past 30 days, they've all fallen pretty far behind, and now you have stablecoins, and then you have decentralized exchanges, etc., topping the list. And a lot of the gas guzzlers have fallen down. So it really changes the main taxpayers on Ethereum. And do you see that balance of L2s being top gas guzzlers coming back with the increase in activity or the assumed increase in activity on L2s and then becoming the top taxpayers on Ethereum again, thinking of it as an economy? Or do you think that thanks to EIP 444, we're just going to start to see complete different composition of the top taxpayers on the Ethereum economy through, for example, massive money market funds going on chain or tokenized real world assets or something like that?
I think if it's not the first one, we're going to be disappointed. I think L2s need to scale, and even accounting for lower blob costs, they should be posting, a large percentage of ETH's revenues in order to say that we have a vibrant modular EVM world.
That makes sense. And you alluded to it a little bit, but I just want to maybe clarify that in terms of value accrual throughout the Ethereum stack now through this most recent fork, where do you see the majority of value accruing going forward? L1, L2, or app layer? Has there been significant changes in that?
I still think it's L1s. It's the main chain, and I would just go back to that snapshot of like how much is ETH monetizing compared to L2s as a ratio of MEV, as a ratio of transaction revenues. ETH's taking north of 80% of the transaction revenues and almost 2/3 of MEV. That's pretty flat compared to pre-EIP 4844. So, my view is that the reason why people use these chains is because the base asset is money, that they want to do business under a different monetary regime. And as long as that regime is predictable, then they're going to see the base asset as money. And if you see the base asset as money, then inflation is hugely important. And the chains that have most of their tokens circulating, where the staking rate exceeds the issuance rate, these are going to capture the vast majority of economic value. So, when I think about portfolio construction, the ratio of like ETH to some L1 that I may own could be a 20-to-1 on position size. Could be more.
Got it. Now, I want to move on and maybe speak a little about the data and say accounting, maybe at a high level, because your valuation models and reports are beautiful to read. And I'm saying that because the way you're able to combine traditional asset allocation and valuation models with on-chain data and really bring new methods forth that crypto native people and builders in this space haven't yet seen, and really makes these assets more approachable for traditional investors. I think pushes this whole industry forward. So I was wondering if you could maybe speak a little bit about how you utilize on-chain data, because that in itself is really a big paradigm shift in terms of how we can do this analysis and then put together these models. So how do you utilize that in your research and analysis, and then what do you kind of see as the specific pros and cons compared to the data before on-chain data?
Thank you for the compliment. I want to just give a shout out to my team because it's a team effort, and specifically our on-chain autist Patrick Bush, who's been helping to write and build a lot of these models. We obviously use on-chain data daily to track the P&Ls and the key performance indicators of the projects that we care about. And as you know, those KPIs like differ depending on what type of chain you're talking about, and that's what makes like looking at across chain so challenging. For some chains, it can be what apps are guzzling the most gas, what apps are gaining shares of fees or developers or active wallets. So I'd say the positives are that the data is available in real time. The negatives is that it is not standardized at all. And when I look at the market structure legislation that just came out of the House of Representatives and has some bipartisan support and really does go a long way to helping stakeholders decide like what's a security and what's a commodity. Even in that bill, it's not going to make it much easier for the industry to standardize around what are the key drivers of economic value, what's the information that needs to be disclosed that everyone is going to look at. There's still really no like self-regulatory organization in crypto that can act as a standard setter, which definitely exists in TradFi. There's lots of SEC rules and regulations that are actually enforced by the self-regulatory body within finance, not so by the regulator itself. So still just finding a huge amount of fragmentation among data providers, how they calculate revenues, how they calculate fees. And we're, doing our best to own some of this intellectual property via our indexing company Market Vectors and their partnership with Token Terminal. We've introduced together some of these fundamental indices. We've introduced an Ethereum staking, a couple of different Ethereum staking indices that measure the total return. But as you know, the best way to know what APY you can earn is to be a validator yourself, because that's how you can generate the primary data, and everyone's experience is a little bit different. So we've also at the VanEck level, we've made a number of investments at the venture level in data providers or kind of pricing providers. It's very early in this space, is I guess my conclusion.
Those pain points that you listed out there have been one of the biggest drivers behind like our strategy, and I think the reason that we also decided to partner with you guys for our indexes is that there's so much fragmentation and difficulty in standardizing and quality assuring a lot of the data for these protocols, and that's why we decided to go with the full stack approach, where we get the primary data running our own node infrastructure, extracting, transforming that data, and trying to introduce the accounting standards for the crypto market, where we then enable investors to look at different line items, compare the magnitudes, do relative analysis, and put labels on top of them, which then people on Twitter can debate whether they agree with the labels, but we just want to put standardized line items out there. So we're trying, but still there's a pretty long tail of crypto assets that we're not yet able to list. There's resource constraints and such. So I do understand from like your perspective, you're probably using a pretty broad suite of different data providers. So as of like right now, in terms of data aggregation for your analysis needs, could you maybe speak a little bit about where you are pulling all of that data in from? And do you have yourselves any sources of primary data? So do you run any nodes?
We experimented with running some nodes a couple years ago, trying to figure out if it's a good business, what types of returns, what types of alpha, can we generate through that primary data? And then over time, we decided that wasn't the best use of our time or capital, and it was better to partner with specialists like you guys. So we've been customers at one time or another of, I think, every data provider in the space. And aside from a couple of exceptions, I think we're not great customers because we churn pretty frequently, like get to know one system, what makes it good or bad, and then try another. I'd say like where our stickier relationships have been with Token Terminal, Glassnode, CC Data, Dune, and the Tie, and Artemis, probably where we're stickiest right now.
Very fragmented. So comparing to pulling everything from the Bloomberg terminal right now, you got to have 10 active subscriptions. So maybe in the long term, not the most sustainable situation. But, as you've mentioned, we're early on all fronts in this asset class. But finally, on on-chain data, you mentioned regulation. The environment is not easy for anyone right now. But then in the big picture, in the perspective we look at it from, is that on-chain data enables a 100x improvement to both investor and stakeholder reporting, but also to like regulatory reporting as well, because you could do that essentially in real time if these standards were to be made. So, do you see the availability of on-chain data changing traditional accounting standards anyway drastically in the near future, or is that just way too far for any of these regulators to yet grasp?
I think we're still some distance from regulators accepting on-chain data. Now, they may for certain elements of the disclosure requirement. Like, let's say that this McHenry bill, market structure bill, actually passes, and it does give some pretty detailed guidelines around what constitutes decentralization and then what information disclosures are required to prove that, yes or no. And one of them is that like nobody over the last 12 months can own more than 20% of your supply. I'm sure that that can be verified with on-chain data, and the regulator is going to have to get used to something as simple as token ownership. But when it comes to disclosing fees or users or revenues, there's nothing in the market structure bill that would require that level of disclosure. And so I still think that's going to be a very bespoke project by project effort, and that the regulators like aren't really going to care about that too much, at least not for the foreseeable future. So but Planet Crypto and Planet TradFi are still, quite many light years away from each other. And I think the convergence is going to take some time. I remember being at a presentation with Binance's head of compliance. It was in the last year or so, and he said that was the number one 0 to 1 change in the industry would be when the regulators start to use the on-chain data themselves rather than some trusted KYC company that is hired in order to do the on-chain due diligence and then stamp it with a regulatory approved, blessing. Seems like it's the latter model, which is much more comfortable. And then, we on-chain degens will live in our own world where we're trying to standardize something amid and amongst ourselves, but Planet TradFi is just not interested for now.
That is very true, but I guess we're both of us probably definitely pushing for the prior of those two models, and we'll see where we land. Probably somewhere in between. But as we're trying to standardize these things, just kind of starting to wrap this up here, the labels that we put on different line items that we do standardize, they confuse both TradFi because when you start from people who have no touching point of crypto yet, it's quite hard for them to grasp these as platform businesses and understand their productive assets that generate cash flows, etc. So concepts like revenue and expenses are very weird to them. But then also on the crypto side of things, we've got actually quite recently on Twitter, we get a lot of backlash from crypto native communities by putting together blockchain P&Ls. And it's interesting because whatever kind of side of the spectrum you go to, there you get backlash from one way or another. And in your models, and you've referred to in this podcast as well, to blockchain and protocol PnLs, which I feel is becoming more the norm for crypto native investors to understand these things. I wanted to hear from you that when you think of a blockchain PnL, what are the main line items that are included in this that an investor should be looking at?
Yep. So let's use Ethereum as the example. For revenue, we assume all items that users pay for Ethereum actions. So that includes base fees, priority fees, and MEV. And we count those three because they all represent net inflows of outside currency into the ETH ecosystem, and each action requires ETH, which must be bought with some outside currency. So that's revenues. And the expenses, we count issuance because that detracts from all the holders of ETH in the form of dilution. And then, so when we calculate profits, it's basically revenues minus issuance. And then the other expense item, which we use in our model, is the validator cut of fees, which is technically detracted from the ETH holder's profit. We think that should be deducted as well. That validator cut ranges between 2 and 10%. And I think that the pushback, like in among us crypto Twitter folks, has been how to calculate profit. Some people look at the revenue and assume that only the ETH that is burned is the base fee. And they say that the priority and MEV are not revenue items. We think that's incorrect because all those actions result in ETH being bought. You need ETH for priority fees, MEV, and base fees. So we assume that all of those are revenue.
That is crystal clear. Thank you for breaking down that simply. Now, just finally on that part, then, how do you assess the economic sustainability of a blockchain given those line items on a P&L? What needs to be considered there? Because if you take the delta between emissions or token inflation compared to actual revenue outside of Ethereum, there aren't too many blockchains you can name that actually have positive earnings.
Yeah, but I totally agree with that. Like it's over the long run, if user fees and MEV exceeds issuance, then it's sustainable. But if that's your model, then there's not too much to give away to acquire new users. So, you can argue that there's lower growth prospects. But, generally we look at all these assets as, Series A, Series B, kind of like not profitable enterprises. And Ethereum is a exception to that rule. And then Solana, during a couple of the months here in 2024 has also been an exception to that rule. And, that for me, that's reflected in position sizes for both of those versus anything else.
Agree with you there completely. I think that is also a great place to wrap up this discussion. Thank you so much, Matthew, for the insights you shared here. Truly a pleasure speaking with you today. Is there any, recent or upcoming research or stuff that you would want to mention here and guide people to read?
We just put out our piece surveying the Ethereum L2 landscape. I think I highlighted the TLDR here, which is kind of prefer the base asset to those L2s. And we're going to have a refresh of our Bitcoin price target. So right now we're at this $325,000 level, which is half the market cap of gold, but it doesn't really account for some of the additional value accrual that may come from these L2s. So look out in the next few weeks for an updated BTC model that takes that into account.
Amazing. Looking forward to that. Thank you so much, Matthew, for this one. Truly appreciate your time and hope we can do this again sometime.
Thank you.